All right, my handout is in your folder. Grab it. All right, just 28 PowerPoint slides. We're going to go hard and fast. This is my 19th year, so I missed the first 11 years. I don't know where I was at. But I've retired from Iowa State now. And I'm still doing what I love doing. So even though I had their mask on, I don't have their shirt on. And now they can balance their $40 million budget shortfall. How's that? All right. So things are going well in Ames. I've got about 10% fewer students than we had last spring semester. Tremendous budget challenges. You're hearing about those. Don't expect that the legislature and the rainy day fund is going to be able to make up that $40 million. The athletic department has a $25 million budget shortfall, and they've already announced they're going to amortize that over 20 years. So if you've got financial problems, you've got to recognize them, folks. This is not a good time to hide. This is a time to say, yeah, I've got to be focused. And I want to be focused today on crop marketing and crop insurance. You know, I'm just down to about 38 days to make ARC PLC election and enrollment. And that includes the weekends. I've only got about 5 weeks, and I need to do something. March 15th is a Monday. FSA would love to hear from you. If you have not called them or emailed them, they're going to send you their ARC PLC election enrollment form. They're assuming you're going to take the same program that you did last year. And again, you decide. I think most all our bean base acres are going to ARC County. Corn base is a tougher call because if I'm going to buy supplemental coverage option, I need to be in the PLC program. That's the interaction with crop insurance and ARC PLC. So let's get started, but I want to compare this whole idea of marketing. This crop, new crop, corn and soybeans, is a lot like Iowa basketball. This is Fran McCaffrey's best team, no doubt? No doubt. They might even have a player that could play in the NBA. Now, I don't know if Joe can make it, but Luka's probably going to go there. All right? And so it's great that we have a successful basketball team. Iowa State is not very successful. All right? And I'm not making excuses. But 3 players that should still be on the Iowa State team are in the NBA. And Horton Tucker had a great game last night for the Los Angeles Lakers, playing Monte Morris and the Denver Nuggets. So there's some talent that has gone through. But when you look at what I'm going to do today, you said, well, what are some things that we've learned from Iowa basketball this year? Number 1, lower your expectations. They were sky high in Sioux Falls and Gonzaga. You're not even going to win the conference. So recognize that your expectations are too high, I believe, for new crop corn and soybeans. I think it's going to be a great year, but I think you've got to sell into these rallies. I think the likelihood is that these February prices that are probably going to come in around $4.40, $4.50 corn. We're up to $4.52 today. And soybeans are going to probably be above $11.50. We traded at $11.70 an hour ago. Up 10. So you've got to separate new crop from old crop in a hurry. So number 1, lower your expectations. We've got the best new crop prices we've seen in 7 years. Number 2, you can only think about playing offense. You think if you score 80 or 90 points, you're going to win every game. You got to play defense. You got to play perimeter defense because somebody's going to show up from Indiana or Ohio and they are going to stroke the nets just like last night. you've got to play defense. If you don't show up and play defense, then lower your expectations. Defense means sell something. Get a crop insurance decision make. Get ARC PLC out of the way. Free up some space at the FSA office. And that's exactly what I want to talk about today. See, we're focused on old crop. That's all we hear on the radio. I've been on the big show 3 times since I retired. See, we can only focus on 550 March corn. You got to have some of last year's corn left. You've got to have last year's corn left, or you've got to be long the board. You've got to let go of last year and recognize that we're short of the 20 crop. We're not short of the 21 crop. We're going to bring more acres, in my opinion, at least 3 million more. We still need good weather. Don't get me wrong. We're going to have high new crop prices. I would say we're at least 6 weeks to 6 months before a sell-off, but it's what you do in that 6 weeks to 6 months that's critical. Because I want to play defense. I want to grab these prices, defend these prices, leverage crop revenue protection. Now, I brought a little different balance sheet because I thought, it's kind of interesting. Usually we hear from advanced trading. Dave Foley's here. But I have been working with advanced trading when I'm in Illinois, when I'm in Iowa. I'm working with Pro Farmer, Cedar Falls Farm Journal. Because I know Chip Flory, I know Brian Greedy. And I said, guys, what are you thinking about? What will change on Tuesday, February 9th at 11 a.m., WASD? And they said, we think USDA's got to recognize that our exports are going up. We've got great demand for our corn feed. Maybe ethanol's been in question when crude oil was $45 4 weeks ago. Now crude's heading for $57. All our energy costs are going up. Fertilizer's going up. Fuel's going up. Crop protection's going up because they're all tied to the energy markets. So we will see nearby March corn futures well supported up in this 540, 550 life of contract this week, maybe push to 560 or 570. But what about the crop we haven't put in the ground yet? That's where my head is today. It's February 5th. We'll probably be planting in 2 months. And I've got to make crop insurance decisions and ARC PLC decisions, and I probably ought to be making some new crop decisions. Look at that last column. USDA will not release these numbers until the 18th, and it'll be a swag. USDA is not going to get out there on the edge. It assumes that we're going to plant 93 million acres of corn in 21. And the 30-year trend yield is going to be around 179. Look at the right column. If that happens, we're going to produce a 15.3 billion bushel crop. But here's what's different in 21. We've got great demand. The use estimated for that crop is 15.025. So we're going to likely see ending stocks not at 2 billion or 2.6 billion as was forecast as recently as August. Our ending stocks would still end up around 1.7. Stocks to use ratio around 11.5%. That's pretty tight. And Pro Farmer is saying cash price maybe 450. That's cash weighted, MYA. That's the one we need for the ARC PLC decision. No PLC payments. We're not going to get PLC payments in October of 22. We're taking PLC because we bought SCO. Now, in my opinion, I think they're too optimistic. I look at what advanced trading, and they're saying 425. And I'm going to bring another number here that's going to say 405. Because I asked Pro Farmer, why do you think we're going to be 450? And they said, well, farmers are going to sell their crops at these really high prices, they're only 20% priced. I think farmers will miss the highs again. You're consistent. You get too bullish at the wrong time. And so when I look at the balance sheets and I look at the projections, that right column, nobody knows. USDA's never released these numbers. They'll come out on the 18th and 19th of February, and they won't be near this bullish. So again, I look at that last column and saying, that's Hawkeye basketball in December and not February. I would guess that these prices, weighted average cash price, will be just a little bit lower than that. Now here's this line graph I've been bringing you every year since 2004. And you've learned to hate this line graph because here's what I say. This is December corn futures indexed to 100 every January for 21 years. And it shows that the high for December corn likes to sit out here in the spring. Usually April, May, June. I will not disagree. But I also say this happens about 85% of the time. 2020 was an outlier. It was a contra-seasonal rally, the likes of which we've not seen since 10. Once every 10 years, we get something like what we saw last year. And a lot of those prices were because of China, communist China. Is that where your confidence is right now? And so when I look at this, I say corn will probably be well supported way out into the spring months. And unless we plant more than 92 or 93 million acres of corn, or unless we have perfect weather conditions, more subsoil moisture, corn's going to be well supported. I see corn spending most of the winter in this 430 to 465 range. You do the math. For most of you, with break-evens around 340, 350, 420, 430, 440 corn off the combines, a 20% return on investment, the likes of which you've not seen since 2012 and 2013. So I want to take advantage of uncertainty, but I don't want to wait until June and pull the trigger. I want to be pulling the trigger while these prices are at levels that we've not seen in 7 years. I want to play defense, not just offense. But when you compare corn and soybeans, it's beans that is the most bullish because we're going to take ending stocks someplace that we've not been since the 2012 crop, the drought crop. And it's not just the U.S., it's more South America than it is us. We only produce about 35% of the world's soybeans, probably heading for 40 next year. Corn isn't near as bullish as is soybeans. That's why we put $6 onto nearby beans and only $2.50 on nearby corn. Be careful thinking that those two are hooked. They're going to compete with each other for acres in a very short time frame. But it's beans that rallied first and beans that rallied fastest. And it has everything to do with supply and demand. Because come August 31st of 2021, we're going to almost run out of soybeans. On Tuesday, USDA will lower that number because our exports are so strong. We're going to have to bring in Brazilian beans into the ports of the southeastern U.S. to make bean meal to feed the livestock. Think through that. We're not going to send beans up the Mississippi. So the basis is going to be extremely strong because the crushers are going to need beans all the way until July or August. That's why this talk of planting beans early is getting to play, because we're going to almost run out. And these crushers and the river terminals are going to be hungry for new crop beans. So when you compare what USDA said on January 12th to what Pro Farmer is saying now, is Old crop beans are well supported because of the tight ending stocks. And we'll probably have to raise that cash price. $11.15, $11.25, no PLC payments. Probably not many Ark County payments in 20. But look at what happens, and this is what I believe in my heart of hearts. I believe U.S. farmers are going to go out and plant 7 million more acres of soybeans. The drier the spring, the more beans. We're going to plant beans in the Delta. We're going to plant beans in the Mid-South. Beans are going to steal from the cotton acres. Corn's going to steal from the upper Midwest, the northern belt. I think we're going to plant 2 to 3 million more corn acres in 21. And I believe we're going to plant somewhere around 7 million more bean acres. Our 30-year yield is around 51. A lot of those beans are going to be sitting double crop behind winter wheat. And so maybe that yield is just a touch high, but we're going to get the beans. But the reality is we've got good use. It assumes that China is still here and we haven't pissed off the communists yet. There's the risk. What if China doesn't come back in here in August, in September, in October? What if Brazil and Argentina gear up for even a bigger crop? That's what will happen. The cure for high prices is high prices. Farmers globally expand. You plant to the edge of the field. You plant right next to the waterways. And then we go get those prevent plant acres that we had last year. But we're still going to have relatively attractive bean price, cash average. And today, river bid, $11.30, $11.40, off the combine next fall. That's probably around $2.30 a bushel profit. I just don't think you want to walk away from that, folks. In my opinion, you've not had this opportunity since the 13 crop to be able to pull the trigger in the winter and get these prices settled. And this is mostly about Argentina and China. It has nothing to do with what we're trying to do. I just think we're going to respond with a lot more acres. So let me pull these all in and let's summarize. And I agree with Pro Farmer on this one. 93 million acres of corn. You said, where are we getting those acres? Dakotas, Minnesota, Wisconsin, crop rotation. Where are we getting the beans? Most of those are coming from prevent plant. 10 million acres of prevented planting last year. They were where the water table was so high. South Dakota, North Dakota, Minnesota, Wisconsin, their water tables are lower. Beans can compete with spring wheat right now. We're just going to see a lot more beans. We're going to plant beans in the Delta, in the Mid-South, where beans can compete against corn and cotton because farmers can lock in that profit. So the caution that I have is expect lower futures prices by harvest for beans. And the basis will be weak because we're going to plant so many acres. Iowa will plant one of their largest bean acres in recent history. You said, why? Derecho. It will be very difficult to plant corn after corn when you got volunteer corn. Trust me, I'm from central Iowa. There's farmers that have been planting continuous corn for 10 years that are going to beans because they can't control the volunteer corn in corn. So we're going to have higher crop protection cost, and we're going to have more beans in the rotation. This would be a good year for some of you to break your rotation and get out of this continuous corn, but I want to do some pricing ahead of time because we're going to steal acres from wheat, especially spring wheat, and maybe abandon winter wheat. And those are probably going to be bean acres. And we're just not going to put a lot more acres into CRP. There's a general sign up now, but we don't get our good productive ground into that general sign up. And it's capped at 27. It's not near as attractive as it was 5 or 6 years ago to be in the CRP program. Now, I am bullish agriculture in 21. I think it's going to be a great year, especially livestock. But I think it could be a really good year for row crop. See, I think everybody's thinking, well, the weather's going to be just like it was last year. It's going to be hot and dry. We're going in hot and dry. But then suddenly, about 2 weeks ago, our tiles started running. Isn't that interesting? I don't know if you've looked out. There's about 16 inches of snow there. Keeps getting squished down. I drove in from Ankeny this morning. It's like driving a doggone demolition derby. Still 70 or 80 trucks sitting up on I-80, and some of them are parted out already. We're getting moisture about every 3 or 4 or 5 days. And yeah, you can say, well, it's all going to run off, but I think we're going to be in much better shape than you can think. But here's the important data. It's coming from university. It's Columbia University. It's the International Research Institute. It says that La Niña fades, and it fades fast. You've been hearing that. That's why they got rain last week in Argentina, southern Brazil. The 30-day forecast flipped. It puts moisture into Brazil, and that's when they need to plant their safrinha crop, and they're way behind on harvest. But it keeps Argentina dry, but look what happens by the time you go to the field. We're not under the influence of La Niña like we have been since last August. We're going back to what we call ENSO neutral. It's El Nino Southern Oscillation. It's somewhere between La Nina and El Nino. And if Elwin Taylor was here, he retired too. Elwin would tell you when we have an El Nino, it increases our probability of good yields. La Nina is what we don't want, and that's the one that's leaving. So we could have much better weather than you're thinking, especially here in the Corn Belt. It was dry going into the fall, but especially the northern belt has been able to pick up a lot of winter moisture, and nothing says that doesn't continue into spring. In fact, I think that says during our growing season looks a lot like 15. 16 and 17. And 16 was our record corn crop. And 18 was our record bean crop. So when you start to say, you know what, maybe this weather isn't all political. This isn't climate change. In my belief, God is in control. You with me? Not John Kerry. I call it the Prius effect. If I drive an electric car, I'll feel better about myself. But 62% of the electricity your car's using comes from fossil fuels. And that's where we're going to go for 4 years, folks. Do you need to feel good about yourself? Great. All right. My wife drives a hybrid. You said, why? 40 miles a gallon. Engine starts, engine goes off. We're okay. We don't have the Prius effect. But I believe go slow on how much you're going to get from carbon credits. They're not $700 and $800 an acre. I'll guarantee you that. Go slow. If you want to be rewarded for what you already do, do it. I just think that you're considering the profitability is going to come from carbon credits. I don't think so. They're going to come from the understanding that I have of supply and demand. They're going to come from what I've learned about marketing. And here's where the good marketers, I say. I've worked with about 5,000 farmers over the last 20 years across the Midwest. And here are the 10 steps that I say separate themselves from everyone else. It's not the size of their operation. It's not the amount of debt. It's not whether they own their land or rent their land. It's their management skills. They know their cost. They calculate their break-evens. They're looking 12 months out, considering the importance of cash flow. That's why you're selling ahead. Now, I've got debt. I've got farm payments. I've got cash rent, machinery and equipment, grain bins, and family living. Next fall and next winter. That's why we're thinking about selling ahead the 21 crop. It's not about outguessing the markets or the USDA or the Chicago Mercantile Exchange. It's a part of managing risk. Most years, most farmers have a goal. They try to make 5 to 10% return on investment. Today is 20% already. Think about it. Twice. 4 times what typically farmers' objectives, return on investment, is where we're at today. I call it controlling the controllables. Quit focusing on all these other things that are going on and just focus what you've got control of. I think some of the other steps are this. They understand the seasonals. They know that corn seasonal only works about 85% of the time. There's always going to be an outlier like 10 and 20. It's about every 10 years. And then we just go right back to the seasonals. And usually for corn, it's spring. For soybeans, not guaranteed. South America is producing the majority of soybeans now. And that's why we see the effect of South America's weather having a bigger influence on us. And when we get 2 weather events in both hemispheres, 6 months apart, that's where it gets exciting. But a year later, maybe the excitement's gone. I think this importance of tracking local basis. You've got some of the best basis in the state of Iowa right now. Said, why is that? The river, GPC, Cargill, Big River. It's because there's a lot more demand than there is supply. 10 years ago, it was the ethanol plants in northwest Iowa. That was where the best corn basis was. Best bean basis has always been here. And now you're starting to see this effect of exports in the global marketplace and more corn and soybeans and ethanol moving down the river. So now you've got to play on basis the likes of which is not better than any place else in the state. And I think this is the value that we have with the Lee Agency. The ability to tie crop insurance to pre-harvest marketing. That is the difference. 50% of Iowa's farmers have figured that out. In the next 10 years, maybe another 20%. 30% of Iowa farmers will never figure that out. They'll never figure out how to leverage crop insurance and revenue protection and turn it into a marketing plan. But I think if you understand the tools and how they work, and then be able to use a variety of marketing tools, I'm going to suggest today it's not just forward contracts and HTAs. I think I want to bring in hedges. I probably want to consider put options. And how do those all fit together with crop insurance and pre-harvest marketing? I don't want to get caught next fall with any bushels unpriced in commercial storage if I don't have to. I just don't like putting bushels in commercial storage. And you can say, well, it worked last fall. You're right. 1 out of 10, 2 out of 10 years. Do I get this type of contra-seasonal rally that I can put bushels in commercial storage? If I've got any bushels left over next October, November, and they're unpriced, I want them on my farm. It's because of cost and basis. I want to be able to move those to where the basis is 10 over, not 30 under. And that's the importance of number 9. And lastly, to create and implement a written marketing plan. I believe 5% of Iowa farmers do this, have a written plan, or will have a written plan for the 21 crop. 95% are blown in the wind. They just like that. They just don't want to be tethered. And I say that is the biggest reason that we fail to do a good job of marketing new crop bushels. And I think we're heading into a year that I think it would be a great opportunity. We've not had this since the 13 crop, that we could sell guaranteed bushels at these kind of price levels. And that's why I think 21's exciting. I think too many times we're looking over our shoulder, waiting for the other shoe to fall. Pandemic, Chinese demand, higher energy cost, higher taxes, and it causes us to do nothing because we're trying to guess what the future holds in store, and God's the only one that knows. Maybe we ought to spend more time here. How's that? Because I think we've lost our focus in 21. So let's bring this focus back into play. Let's start by understanding our break-evens. These are your records, but for today I'm going to use Iowa State's numbers because 2 weeks ago, Dr. Andahalo Plastina released our cost of production. To grow corn following soybeans, average yields in the state of Iowa, those costs are $6.64. You can find them on the Ag Decision Maker site, file A120. Let's pretend today that my APH is 190. I don't know your APH. You're going to have to figure that across all farms. Just take your average APH on your farms. It's a crop insurance number. It's probably a 10-year simple average, and that tells you what that break-even is. In this example, it's 331. I don't know yours. I hope you do. I hope you do this at home. Is just take what you think it's going to cost, produce an acre of corn following beans, and I'm using average. Remember, we use high third, medial, and low third. I'll do the same with beans. And bean costs are up about 3%. Corn's only up about 2% from the previous year. And a lot of you put fertilizer on. And your fuel tanks were full in December. That was great strategy. It's because those costs are going up. We're not going to be able to buy fertilizer anywhere close to where we could have last fall or fuel. And I'll simply use my APH, and let's say in this particular example, all right, I brought a little different graph, 63 bushel an acre APH. That is where you start with the marketing plan. Do not get caught up in the noise. You're going to turn on market to market tonight or Sunday at 12:30, and somebody's going to try to tell you what to do. They don't know. No one knows. You're going to turn on the big show. You missed it today. They don't know. The market analysts don't know. And so the reality is control the controllables. Focus on your costs, average. Corn following corn, corn following beans, beans following corn. Start with that number. If those were your numbers, and your basis for corn is 20 under at harvest, I see you making 70 to 80 cents a bushel. Net. Now multiply that 70 or 80 cents on 200 bushel. That's the most money you've probably ever made without crop insurance. You with me? Same way with beans. Beans are even more exciting. If your cost is $8.94, you can sell beans off the combine, the river, October, 11.20. That's 50 under. 11.30, 40 under. That's $2.50 a bushel. That is a touchdown, Iowa State. You've never done that before. What? Well, I've got more than 11.30 before. Not off the combine. That doesn't happen very often. That's the importance of having a new crop marketing plan tied to crop insurance, because we are at extremely high levels, and we tend not to stay here for long periods of time. So let's tie the loose ends together. And these are loose ends because we've got some decisions to make, and we're down to 5 weeks. And that is large canyon walls. And this is the safety nets that are provided. The little safety nets in the bottom of the canyon is called ARC PLC. ARC stands for Agricultural Revenue Coverage, PLC, Price Loss Coverage. These are the decisions you've made every year for 7 years, and you still don't remember how it works. And now you're making annual decisions. ARC PLC is a very poor risk management tool. It is very poor. It's in the bottom of the canyon. It's just going to keep you from hitting the water. And PLC doesn't trigger unless we're below 370 corn and 840 beans. And if you're using that as your safety net, you're going to go broke, young man. But you need to make an ARC PLC decision. Buy commodity crop by FSA farm number, and I'll come tie those together. There's the big safety net. There's the one that keeps you farming for another 5 or 10 or 15 or 20 years. It's called crop insurance. And the government probably pays 55 to 75% of your premium. There's your safety net. And then you heard this morning, hey, there's a couple other safety nets here, but they're not farm-based coverage, like multi-peril crop insurance. These are county-based products, and I'm not against them. It's just more risk management tools that you have available, and you've got more than any farmers in the world. Nobody's got these. And no government subsidizing them like your government is. And so what you've got to do in the next 5 weeks is discern, so what am I going to do for 2021? Okay? It's a 1-year annual decision. See, we've not done this. Maybe that was what was confusing. It's just a 1-year election and a 1-year enrollment. It has nothing to do with crop insurance, has nothing to do with Title 11. It's Title I. And you're going to do this in 22, and you're going to do this in 23, so you might as well figure it out. It's just going to be a choice by commodity crop, by FSA farm number. ARC individual, ARC IC, ARC county, ARC CO, or PLC. It's just a 1-year, only for the 21 crop. See, in 15, you made a 5-year decision, 14 through 18. Last year, you made a 2-year decision, 19 and 20. Now we're going to just make annual election and enrollment. And many of you updated your PLC yields by last September. That was smart. So now you likely have a new PLC that can be used to calculate. Now, I've done this meeting 200 times all over the Midwest. This bores me to tears because I know what's going on. This is too complex. You just need to tell me what to do. I'd be glad to. Here's what you did last year. You went PLC on corn and ARC County on beans. Can you see it? Now, why did I do that? Because you don't trigger PLC on beans, and you're not going to this year. Almost all our bean base acres are all heading for ARC County. So when you get your papers from FSA because you didn't call them or email them, and you've only had 3.5 months, I know you've been busy. You had 3.5 months to do this, and now you're down to 5 weeks. Do I believe that farmers will do the same thing they did last year? No. Iowa farmers are going to go ARC County most all their bean base acres. And we're going to switch a lot of these corn acres from PLC to ARC County unless I want to buy supplemental coverage option. That's an Iowa State first down. If you've got that, this is going to work for the next 3 to 5 years. If these prices are going to be so high, which they are, then why am I in PLC? I think you're in PLC because A, you want to buy supplemental coverage option, or B, you can't figure this program out. I'm serious. Half the farmers in Iowa, in my opinion, cannot figure this program out. Just whatever Steve Johnson says, I guess that's what I do. I got 3 emails while I was here this morning. Well, what do you think I ought to be doing on ARC or PLC? ARC County, corn and bean base acres, unless you're buying SEO. Could I say that another 52 times? You want me to do that on the big show on Monday? Because I'll do it. And you said, why? You're not that smart. You're from southern Iowa. All right, well, you got that right. Let me show you how it works. It's a math problem. I learned it in 4th grade, okay? And I went to the public school. That's kind of surprising. In 4th grade in public school, I learned this math. Watch this math. This is the effective reference price. It hasn't changed since the 14 Farm Bill, 7 straight years. It hasn't changed. It's probably not going to change for 22. Figure it out. The national average cash price, the weighted average, the MYA, has got to be below $3.70 corn. This year, the work at Kansas State says probably close to $4.23. Somebody that's really good with math, is $4.23 below $3.70? No! There's no PLC. You're not collecting. All right? Beans, $8.40. Is $10.76 below $8.40? No! You're not getting a PLC. Wheat, at $5.06. Is $5.06 below $5.50? Yes. 44 cents. The people that are in wheat and sorghum go slow. Or peanuts, or rice, or cotton, go slow. But if you are in corn or bean base acres, this has nothing to do with what you're planting in 21. This has historic base. Here's the work of Kansas State last week. They think best guess, 405 corn, 984 beans. I don't disagree. It's good land grant school, Big 12. This is their likely probability distribution. Even wheat looks like it would not trigger PLC, and we'll see a lot of those wheat acres probably heading for Ark County. So let's go back to 4th grade, okay? My teacher's name is Mrs. Wolf. Yes, she did fit that description. All right. Mrs. Wolf, teach me how to do some math. All right. Stevie, I'd be glad to. Let's pretend you've got a farm with a 100-acre corn base. Has nothing to do with what you're planting in 21. You can plant that marijuana. All right. You don't have to plant corn because ARC PLC is historic base acres. All right. So let's pretend you've got a farm, and on that farm, there were 100 acres of corn base. Do the math, okay? You had a chance to update your PLC last year. If not, you've still got the PLC yield. Some of you still got the same PLC yields you probably had since '02. All right? Show me, Mrs. Wolf, how does this math problem work for PLC? Well, Stevie, $3.70 is your effective reference price. And Kansas State says best guess, MYA price, that we won't know till September of 22, is $4.05. Is $4.05 less than $3.70, Mrs. Wolf? No. Now here's what Mrs. Wolf taught me. Any number times 0 equals what? There it is, right there. Why are you in PLC? Because A, you think we're going to be below $3.70 national cash for the marketing year. Or B, you're taking SCO. You got it? Just give me a nod. Not a yawn. I said a nod. Yeah. That's it. That's how simple it works. Most Iowa farmers are heading for Ark County corn and bean base because PLC will likely not trigger in 21 unless you want to buy SCO, okay? So there's a webinar. It's free. It's going on right now. It's from Iowa State. Sorry I conflicted with it, and you missed it. It's on the ISU Ag Decision Maker, so I did your math for you. I knew I was going to be in Muscatine, and I let Ryan Droletti, who covers this part of the state, as farm management specialist, I just plugged in the numbers. Here's what I did. This is our free spreadsheet. I said free. Wherever there's a yellow cell, it's looking for numbers. I used Kansas State's 405. I didn't know your PLC yield. You're going to see it when FSA mails you your forms, or it's on the 156 EZ. Did I say EZ?
That was easy.
Yeah, EZ form. And it might have changed this year, might not have changed, okay? And then I went into the spreadsheet and I put in 405 and I put in 170. And I let this Excel spreadsheet do my work. Now, I've got to make some assumptions. The 21 Muscatine County yield, since I can see 15 through 19, I took a simple average, and the answer is 194, good dirt. Your average, your simple average yield is 194. 5 years. Always uses 5 years. So your 5-year county average is 194, okay? So I plugged it in, and it showed me that there would be no Ark County payment unless your county yield went below 170. And it showed me there is no PLC payment. The answer is no payment. No payment. And you said, so why am I doing anything? Because if you don't, then you are going to default right back into the same program. You can only sign up for the same program you were in last year. I would sign up. I would get off the couch and call FSA or email FSA if I wanted to change from PLC to Ark County on corn. You with me? I would probably have most of my acres in Ark County, just in case there happened to be a low county yield or price was lower than this, but we're likely not going to trigger PLC. Don't make this difficult. Same way with beans. I'm in Muscatine County. Same assumptions. I need a price. I'll use Kansas State's 984. It's not below 840. No PLC. You said, well, what should I use for a PLC yield on my farm? I went ahead and plugged in 45. It's probably around 81% of your production from those 5 years that we were given, but it's in the ballpark. And you said, well, what's our yield going to be next year? I'm simple-minded. I used a 5-year simple average. Simple average for the 15, 16, 17, 18, and 19 crops. I can pull it right off here. I can see it. Not the trend adjusted. The simple average is 59. I plug them in. It says no payment, Ark County, unless my yield's below 48.5. That's why I'm in Ark County. Beans, no doubt. I haven't triggered a PLC ever, but I've triggered Ark County every once in a while because it's a revenue product, kind of like revenue protection. And we're not going to trigger a PLC. Make this simple, folks. The spreadsheet's been out here since early January. FSA's been waiting since October, and now you're down to 5 weeks. Do not make this finals week. Do not make this a finals week project. It's crazy. FSA is working remotely. They just want to know, are you going to change anything? Are you going to stay PLC corn and Ark County soybeans? And then free up your time because here comes the important decisions. Crop insurance and pre-harvest marketing. This is the big money. This is the one that saves your farm for the next generation. And there's not a lot of changes. I heard Logan talk about that. You know, basically the fact that there's a new QLO option. Make sure your agent checks QLO just in case there were any quality loss issues. You don't pay for it unless you use it. But there's the importance of your unit structure, of the supplementals you can still buy. Revenue protection can be taken at the 65, 70, 75, 80, or 85% level. This is multi-peril. This is farm-based yields, your APHs. Now let's add these 2 new products, and one's not new. But these products are called SCO supplemental. What do you know about supplemental? Got to be in PLC. There's the only interaction. FSA doesn't care that you're buying SCO. They just want to know that you want those base acres for that crop in the PLC program. The reason that supplemental S and enhanced E are so attractive is because the government is paying most of the premium. If you take supplemental, you go from 80%, I'm going to show you an example. You go 80% revenue protection, then you can buy 6% of supplemental, and the government's paying 65% of the premium. They don't subsidize these products. That's a checkbox. That's a checkbox. That is an important decision. And those are decisions that you've got to make with your agent if you're going to make changes. Now, I was out here teaching last year, and I was way ahead of most everybody talking about supplemental. And I know where I was at. I was in Huxley, Iowa, doing a farm bill meeting. I was having a cup of coffee, trying to figure out how I was going to teach 110 farmers. How does these products work? And then it came to me. It's a cup of coffee. Crop insurance is a cup of coffee. And I've got to decide how full do I want that cup with revenue protection. 65, 70, 75, 80, 85%. You decide. That's not my decision. We know that the prices projected are going to go up. Premiums are going to go up. For today only, I'm going to use 80% revenue protection. Stick with me. Now, I can add a product called supplemental. There's what it does. It's county-based. That 6% is the difference. 86 minus 80. Let's do a math problem. Let's say you're at the 85% level. How much supplemental would you be buying? 1%. At least price it this year. Take 20 minutes out of your precious life and work with your agent. And I'd rather do it in early February than early March because they're going to get really busy. What this product is doing is adding cream in that cup of coffee. You with me? I drink lattes. All right? So I'm just adding some cream. I can add 1% cream at 85% revenue protection or 6% cream in this example. So I'm accepting a deductible. There's the importance. I've got a 14% deductible. But I've got to be in PLC on the base acres for that farm. And it's not farm-based, it's county-based. Now here comes another new cup of coffee. It's not the same cup of coffee. All right. I take 80% revenue protection. I'm going to leave this gap between 80 and 86% bare. I don't have any coverage. But here comes the enhanced E. I can buy one of two triggers, a 90% trigger that covers the gap between 90 and 86, or the 95% trigger. This is shallow loss. It sounds expensive, but look what you're doing. Is you're buying some sort of a county-based revenue product that sits on top of your own farm-based product. And it doesn't care if you're an ARC, or it doesn't care if you're in PLC. And I think you saw Logan and Rob present this morning. This is the one that paid off like $500 of premium and it paid you like $700. Is that over the years this one would pay. And it's subsidized at the 51% government money if you buy the 90% trigger, or 44% if you buy the 95. Now, here's why SCO and ECO are starting to look more attractive. It's how the subsidies work. These have not changed since 2009. So we're getting ready for year number 12. This is how crop insurance subsidies work. If you're in the optional units by county, then you're insuring your farms at the section line. Fields in the section. The higher the level of coverage, revenue protection, the smaller percent the government subsidizes. In 2009, a lot of you moved to enterprise units because you said the government pays a lot more, but you're taking more risk because all of your cornfields in that county are combined. And that's why you likely buy hail and maybe wind and green snap. because you're insuring all your cornfields together. This is why supplemental has a play, because if I go from 85 to 80% revenue protection in enterprise units, I get a product that covers this 6% gap, and the government pays 65% of the premium. Now, folks, it's going to work like this for the next 3 years. So don't think this is one and done. And you don't have to relearn this. Spend some time with your agent. Get the ARC PLC out of the way next week. And then focus on crop insurance. And focus on these crop insurance changes. And then focus on the pre-harvest marketing using revenue protection. You've seen me use this slide for 12 straight years. It's a simple visual. It's my farm-based product, revenue protection. This has nothing to do with supplemental and enhanced. Let's say your APH is that 190. That's what triggered that roughly 331 break even. Let's say you're at the 80% level. You can go to 85, can't go higher than 85 unless you buy some sort of a supplemental product that goes with it. You are guaranteed 152 bushel an acre. If the planter drops the seed, you're guaranteed 152 bushel an acre. So look at that. This is cooler than crap. They'd love to have this in Brazil or the Ukraine or China. They don't have it. And the government isn't paying most of the premium. You're also guaranteed whatever that simple average price is. Today it looks like it's going to be closer to $4.50. And we won't know until early March. That's why we don't know the premiums, but we can come pretty close to it. I'm guaranteed $669 an acre. You've not been able to do this for 5 or 6 years. You said, well, I got to have $700 an acre. My lender was at that meeting. Go to 85%, and you're there. You can create larger revenue guarantees. You go to higher levels of coverage, you have more guaranteed bushels. But do not commit to delivery those deductible bushels. That is a sin. That is a mortal sin. Don't get so caught up that you say, I'm going to sell 200 bushel an acre. I'm going to deliver them to GPC in the river, and the ethanol plants. Don't do that. Do not commit to delivery more than 152 bushel. I wouldn't even go there. I'd stop at 130, maybe 140. And I'm probably going to use forward cash contracts and hedge to arrives. If you understand that upper right-hand corner, you're in the graduate school of crop marketing. What I want to do today, I want to separate my delivery bushels. Bushels that I'm willing to commit to deliver, whether it be at harvest or post-harvest. I've got bins. I can hold those bushels away from the market, but I'll go ahead and use a December forward contract or a December HTA for corn. For beans, I'll probably use a November or January. I'm guaranteed the higher of December corn, November beans, in the month of February, projected, or the month of October harvest. This is what's cool. Built into revenue protection is the harvest price. Do not exclude it. Don't get cute. This isn't the year to get cute. I'll save $2 an acre. I'll take the harvest price off. Don't do that. Don't take that harvest price off. Leave the harvest price embedded. Now, here's your risk. Your risks are basis. And Logan mentioned this. You're near the river. We would get large export demand and the drought would sit right here like it did in 2005. What if the cash price is higher than the December corn futures or November soybean futures? It probably hasn't happened since 2005. So there is a slight basis risk because crop insurance settles up at the futures price. It's either that February simple average or October simple average, December corn, November beans. And Rob mentioned you better make sure you plant the crop. If you're farming the river or the creeks, or the streams, or this morning, Interstate 80, be careful. Because you only collect 55% of your revenue guarantee, of your $669 an acre. Now let's take this a little bit further, because for some reason I had this epiphany that I've been using this slide for 12 years, and I've probably seen about 14,000 farmers. And my epiphany was this: go further, Steve. Show farmers something that they typically don't see. And I got home from church on Sunday, and yes, we're in person. Got tired of watching that on the internet. And God gave this to me. Pre-harvest marketing strategies and tools. Create an example, a visual for corn. This is your cup of coffee. It's the corn that you are guaranteed. It's $669. If you put that corn in the ground and you don't raise a bushel, you're getting a check for $669 an acre. That's how the derecho boys made money this year. All right? They made a lot of money on crop insurance. And so when you look at this, I want to create 3 different marketing tools. And if Dave Foley was here from Advanced Trading, Dave would steal this from me. Okay? What if I say, you know what, Steve, I know my break-evens and I know my cash flow, and I need to price at least 50% of my APH bushels. Those 152 bushel, I need to sell at least 75 bushel an acre to make my cash flow work next fall and winter. Great. Let's pre-harvest market for delivery using forward cash contracts and or HTAs. I'm more likely to use an HTA this year because there's likely going to be uncertainty of basis. The reason I'm going to use HTA is because I don't think I want to fix that basis yet. The exception will be if I'm delivering beans in October, use a forward cash contract. This basis could get sloppy on beans. If we grow that extra 7 million acres, and we grow a lot in west central and east central Iowa because of the derecho. So I'm only going to price 75% of my bushels for delivery, and I'm guaranteed 152. But we're not done, because I believe there are other marketing tools. We could have a broker, and we could work with our broker to say, hey, if we get this corn futures up here above 470, 480, December corn, let's go ahead and hedge another 10% or 20%. These are your bushels. You're guaranteed 152. They are non-delivery bushels. See, this is what we missed last year. We get so caught up in the delivery bushels, if we didn't commit those bushels to delivery, then we can go ahead and make money on them. The risk is, if we hedge, what happens when the market goes higher? We get margin calls. You with me? Yep. Oh, I don't want one of those. Why? If you felt comfortable at pricing corn at 470 December, 480. In other words, I'm saying if we go higher in the spring, then don't make bushels committed to delivery. Consider hedging. You don't have to deliver the bushels. Or buy put options. These are all tools that are available to you. The first one, you're working with your merchandiser, wherever you deliver. Number 2 and number 3, you've got to have a broker. All of the above. All of the above. You don't have to sell all your bushels, and you sure don't want to sell these because these are your deductible or these are that county level product. So you can guarantee a large revenue, but I think the key to 21 will be the marketing plan that comes with it. It's how many of those bushels are you willing to commit to delivery? My insurance bushels. I'm not saying sell 80% of them. You're at 80% coverage, but you can commit 65 or 70%. If you want to go to 80%, then go to 85% revenue protection. And so what it brings in is the weakness of Iowa farmers. They have trouble determining what is a good price. I believe a good price for December corn today, my opinion, is somewhere between $4.30 and $4.65. All right? I've never said that. Excuse me, I've never said that, Muscatine. Let me say that again, loud and clear. I believe a reasonable price objective for the 21 crop is when December 21 corn is trading between $4.30 and $4.65. Just create a good overall average. It's $4.52 today. I hope it's the cheapest corn you sell. But it's returning 20% return on investment. It's keeping these bushels out of commercial storage, and it's helping my cash flow work next fall and winter. I'm guaranteed bushels, and I'm guaranteed price, and as long as I'm above that spring price, that I think is going to come in around $4.40. It's trading at $4.52 today. And our life of contract high was $4.65, and that was a month ago. I think our highs are in. Steve Johnson, retired Iowa State, says, for new crop bushels, I think our highs are in for the winter. I said that a month ago. I said that yesterday. I think our winter highs could be in. It's going to take a major weather event in the northern hemisphere in the spring or summer to think that we're going to blow these out. The cure for high prices is high prices. For soybeans, $11 to $12, and we touched $11.70 for a minute today. Just create a good overall average. I think your easy sales are when something's going wrong in South America, in my opinion. Has nothing to do with you. It's when something goes wrong in South America and China is buying. We've never seen those simultaneously. This just doesn't happen very often. And so I'm even giving you what I think are reasonable price objectives. If that's the cheapest corn new crop that I sell and the cheapest new crop beans, it's going to be a great year. I'm going to buy another farm. I'm going to build some more grain bins. I'm going to have to get over to the doggone Farm Progress Show, Decatur. So I'm going to kick some iron. I'm going to spend some money. 21 is shaping up to be one of the best years we've had in farming. Row crop since 13, the record. It's shaping up, but I think it will be to those that learn to manage risk. When I look at what tools do I think farmers should be focused on, in my opinion, futures prices and basis. Futures will go lower by harvest, and basis will weaken. I think I want to use forward cash contracts on beans off the combine. I think that bean basis, even at the river, I think that bean basis will be weak in October. But here's the good news. It is going to be strong in September. Most of our bean basis is probably 30 to 40 under the November in October. If you can harvest beans first half of September, you're probably going to catch a 20 or 30 over. That's 50 more cents a bushel than your neighbor's going to get in October. I think I'd use an HTA if I thought I had a chance to grow September harvested beans. You with me? I was on a webinar yesterday with Farm Credit Illinois, and Matt Bennett and I spent 10 minutes talking about this strategy. Now be careful. Remember, that idea of planting early has risk. And you don't know whether you can cut those beans in September. But I'd probably use an HTA. Then when I got into August, I'd probably go ahead and decide whether I can commit those bushels. We are going to be out of beans in September. In October, we're going to have beans coming out our ears. You with me? It's a basis play, but you better grab the futures in advance. Grab the futures in advance. In my opinion, all right, I want to use an HTA, hedge to arrive, non-roll, for both corn and soybeans. Most of the bushels that I'm going to be harvesting, I'm going to commit to delivery, and I'll use a hedge to arrive, but I don't want to set the basis. I think we've got a lot of uncertainty of basis right now, including corn, because we're not going to run out of corn in September, and we might not have, all right, the same type of basis play for corn that we do for soybeans. And here's where my grain bins work. I can go ahead and HTA December corn, and then I decide whether I'm delivering those bushels in October or November, or work with my merchandiser and roll them till March and pick up better basis at Christmas in January. I like HTAs. And if you don't want to deliver the bushels, fine, hedge. Work with a broker. You have to make margin calls if the market goes higher, but at least you're locked in at that 470, 480 without committing bushels to delivery. Or buy a put option. But you want to buy a put option when you think the price is at its highest level. That's when the premium will be cheap. And I don't like to use puts now because you're paying time value. And I just don't like to spend a lot of money on time value. I'll probably wait for the puts in June when there's less time value. So I think you've got roughly 6 weeks to 6 months to really weave your plan and put all of these pieces together. The bushels that are left over, great. That's where we have the idea of storing and waiting. We could use delay price contract or minimum price contracts. But the lower part of this slide is where I want to be for new crop. With the likelihood is futures will come under pressure, but not until we see there's a large northern hemisphere crop coming. It won't be March 31st. We still got to plant the crop. And we're going to keep risk premium in the new crop corn and beans until we not only can be guaranteed the acres are planted, we've got adequate yield. So I won't be surprised that we could keep these premiums here until maybe the middle of July. But sometime between the middle of July and the middle of September, I'm concerned that we're going to put new crop futures under a lot of pressure. Under a lot of pressure. And then we're trusting the communists will be in to buy our bushels. If the communists say, screw you, we're in trouble. Because now we're dependent upon our export market. Higher crude means more ethanol demand. Eventually, we're going to drive electric vehicles. I'm not, you are. Prius effect. But we're still going to have to use fossil fuels to make the electricity. We're probably going to have to take our ethanol plants and make something else. Ask John Kerry what he wants us to make for his jet. We're probably going to have to make something besides unleaded gasoline. Reality, check. So I think the ethanol demand, if we get much more than 5 years out, I don't know what we're going to do. 40% of our corn is going to ethanol right now. 40%. So I think we are going to see adjustments. I don't think it's going to happen in 5 years. I don't think we're going to see this big rush to electric cars, except on the West Coast and the East Coast, especially Washington, D.C. I'm not driving an electric car. All right, I'll be with those same 80 trucks that are sitting out on their I-80. And by the way, 2 of them were Amazon Prime. You might not be getting deliveries today. Just letting you know. Lots of great websites, you know. So let me conclude. This is an annual event, folks. Every year for the next 3 years, 21, 22, 23, this is what it looks like. Get ARC PLC out of the way. Help the gals at the FSA office, all right? If you don't understand how base acres and PLC yield, you're going to see it on the forms. Do not make this tough. We have made ARC PLC differential equations, calculus, 4th grade math. ARC PLC is 4th grade math. Just get this done and work with FSA. Just remember that you have to elect and enroll by commodity crop, by FSA farm number. It has nothing to do with what you're planting. Has nothing to do with what you're planting. 21. It's historic base. It's historic yield. But there is an interaction, and this is going to be here in 22 and 23, probably 24 and 25, 26. The interaction will probably be this. If you want to buy supplemental, you need to be in PLC. That's the interaction. And the March 15th deadline. Not an accident. FSA knew that you like to make decisions by March 15th for crop insurance. That's why they made March 15th. I always say, give a farmer a deadline, they'll show you how close they can come to it. March 15th is a Monday. Crop insurance industry calls it March Madness, and it has nothing to do with college basketball. Nothing. Farmers procrastinate and then try to pull off finals week right out in front of that deadline. And it's not going to be healthy this year. And then finalize your crop insurance decisions. You're walking out of here with those printed forms. I was the one that suggested 440 corn, 1150 beans. If you're wondering who came up with those crazy projected prices, we might be a touch higher than that. And remember, volatility the last 5 days of February also determined premiums. So we're not going to know your premiums until probably March 3rd, March 4th. So make sure you're talking with your crop insurance agent. And Steve Johnson will always be a big proponent of pre-harvest marketing. I will never leave that stage. We've got too much money at risk. We're trying to manage $700 or $800 an acre on corn, $500 to $600 on soybeans, and we've got crop insurance and the ability to pre-harvest market to make this a lot easier. So where would I go to find the websites? They're in front of you. Iowa State, there is the brand new ARC PLC payment estimator. It went live a week ago. These are the free webinars on the website. Yours for Eastern Iowa is next Tuesday, February 9th at 1 p.m. It's free. You need to register online. Ryan Droletti will walk you through an example. It'll look a lot like the example I put in front of you for Muscatine County. The answer is no payment, no payment. Any number times 0 is 0. Do not plan on collecting ARC or PLC. You don't want to. It means the wheels are off. If you collect ARC PLC, the better odds will be ARC County, University of Illinois, Farm Doc, great tools. Crop insurance estimator, you can go in and do your own crop insurance estimators. Any state and any county, you can go do their calculations, but the Iowa is the model for the country. This is the gold standard right there. If you are in an Iowa county, that is the gold standard. Because Dr. Plastine has put some bells and whistles, but the answer will be the same. No payment, no payment. It's likely you're not going to collect, but you still need to make an election and enrollment. I got my prices off of Kansas State. They do a great job. They update these every month. Those numbers came Friday. That's where the 405 and the 984 came from. They have already estimated those. And then if you want to go back and learn what you've had 7 years to learn, you can go back and find the ARC PLC numbers. So with that, let me field a few questions that you have of me, okay? So go ahead and, Ryan, grab the microphone and hand that to somebody. And let's see, do you have questions of me? I'm pretty intimidating, you know that. Questions that you have of me? Questions? Dwight's here. You told me he's home moving snow. Slacker. The question was, any interest in a multi-year crop sale? The 22 crop, I believe I would go slow at pricing the 22 crop at less than $4.20 December 22 corn. All right. I'm cautious. I think costs are going up. I think taxes are going up. I think energy costs are going up today. I think you've got to be careful unless you own your own land free and clear. If you have half your cost already set, then maybe you can manage that risk. But I don't want to be too aggressive of selling 22 at this point in time. If we would blow December 22 past 425, I might consider it. But I believe there's too much risk that costs lift. I'm concerned about inflation. And while we feel good about higher crop prices, our expenses are going up in 22 and 23 and probably 24. Plan accordingly. Good question. Other questions? These energy costs are getting away, folks. I hope you've got your fuel tanks full.
There's a report coming out next Tuesday. Do you think there's going to be any surprises like the last report that came out?
Good question.
Thank you.
There's a report coming out on Tuesday. The surprises will not be on the supply side. They won't change those numbers. The surprises, if there are going to be on the demand side, and it's going to be exports. It will be the export side. So I believe that crude oil's gone up 15%, 6 weeks. Ethanol is probably going to be well supported up here with higher crude. Ethanol price is $1.70. The ethanol plants are probably going to be able to run most of the spring and summer where we weren't sure they were going to be able to run. So I think the good news is on old crop corn and old crop beans. You've got to separate new crop. You are not going to see any new crop numbers next week. The 18th, USDA will release their first glimpse at the 21 crop. You with me? But I don't think they're going to put those 10 million acres in there. I think they probably will only put 7 or 8 million more corn and bean acres. And they will not change very much. So don't think that there's going to be surprises on the new crop side. We just are not going to see anything until March 31st, prospective planting. And then May 10th is the first time that WASDE creates a 21 crop balance sheet. So don't wait much longer. Get ARC PLC done. All the announcements on Tuesday, February 9th, old crop demand. That's where the changes are, both U.S. and South America. Good question. Other question. Other question you might have me? Iowa State football. Yeah, I appreciate that question. Yeah, Iowa State's going to return 20 of 22 starters next fall. We will be ranked in the top 10 football programs in the country. Now, here's where it gets exciting. The Hawkeyes are coming to town. Yeah, we didn't have to go to Iowa City, but you get to come to Ames. It'll be the 14th day of September. There are only going to be 62,000 tickets, and I'm going to have one. And I'm going to come early. And you know why I'm going to come early to that game? Because they're both going to be ranked in the top 20. I'm going to come early to that game because when Iowa State football runs out onto the field, they go to the southwest corner of the end zone, and they take a knee. And they say a team prayer. And the Iowa Hawkeyes, when they sing the Star-Spangled Banner, they too take a knee. Good luck. God bless. Thanks for inviting me back to Muscatine. Have a great year. Thanks now.